Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Today, we're diving into the latest updates from a really key player in, cloud observability and security. Our goal here is to unpack the essential insights from Datadog's recent business update, figure out what really matters for understanding where the tech landscape is heading.
Exactly. We're zoning in on Datadog's second quarter of 2025. And the aim really is to pull out the most significant bits about their financial health, their strategy, and importantly, their tech advancements. Especially, with AI being such a huge topic, this should give you a much clearer picture of the big trends shaping tech right now.
Okay, let's start with the big picture, their overall health. The Q2 numbers look, well, pretty strong on the surface. They reported revenue of $827 million. And that's a solid number, obviously, but it's also up 28% year over year. And maybe more importantly, it beat the high end of their own guidance. What does that tell us about how they're doing in the market and, executing their plans?
Well, beating your own guidance like that, especially the top end, it says a lot. It's not just hitting a target. It points to some real underlying strength. They specifically called out higher than expected usage growth from their existing customers. And in the world of SaaS, software as a service, that kind of usage growth is, well, it's golden. It means customers aren't just sticking around. They're actually using more of the platform, processing more data, adding more services.
So it's becoming more deeply integrated into their operations.
Precisely. It suggests Datadog is getting really embedded, almost indispensable for these clients. That creates a really strong organic growth momentum. Plus, you've still got those big market trends pushing things along, cloud migration, digital transformation. Those haven't gone away.
Yeah.
And look at their gross revenue retention stable in the mid to high 90s. That screams mission critical. Churn is incredibly low when your tool is that essential.
Right, that retention number really underscores how sticky it is once a company adopts it. Okay, so strong revenue beat driven by usage. What about profitability and cash flow? They reported $165 million in free cash flow. That works out to a 20% free cash flow margin. How significant is that for assessing their operational strength?
Oh, a 20% free cash flow margin is very healthy. It shows they're not just growing the top line, they're doing it efficiently and turning that revenue into actual cash. That financial health is vital. It means they can keep investing heavily in R&D and sales without needing to constantly look for outside funding. It fuels the engine.
Makes sense. And just to complete the financial picture, they mentioned billings were $852 million, up 20% year over year, and RPO, remaining performance obligations, hit $2.43 billion, which is up a hefty 35% year over year.
Yeah.
But they also kind of downplayed billings, saying revenue is a better indicator. Why is that?
Yeah, they tend to guide more off revenue. Billings, can fluctuate quite a bit based on things like how long contracts are, or when they get invoiced. It doesn't always perfectly mirror the underlying usage trends quarter to quarter. Revenue recognition gives a smoother, more consistent picture of the actual services being consumed over time. That said, the strong RPO growth, up 35%, that is significant. It shows a really strong backlog of committed future revenue, which speaks to long-term stability.
Got it. So revenue is the steady pulse. RPO shows the long-term commitments building up. Now let's look at the customer base itself. Overall growth looks good, about 31,400 customers now, up from around 28,700. But the really interesting part seems to be the growth in larger customers, right? Those spending $100,000 or more annually.
Absolutely. That number jumped quite a bit, from about 3,390 to around 3,850. And these bigger fish, they account for, 89% of the total ARR. It really highlights their focus on the enterprise market.
And these customers aren't just signing up, they're using more and more of the platform. You mentioned usage growth earlier, but the multi-product adoption stats are striking too. 52% of customers using 4 or more products now, up from 49%, 29% using 6 or more, up from 25%, and 14% using 8 or more, up from 11%. Can you unpack this platform strategy a bit more? Why is getting customers to use more products so beneficial?
Well, this multi-product adoption is probably one of the most important metrics to watch. It's the core of their strategy. When a customer starts using Datadog for monitoring, then adds logging, then APM, then security, they're consolidating their entire view onto one platform. Think about how complex IT environments are today. Distributed systems, microservices, clouds. Information gets siloed really easily between different teams using different tools.
Right, the monitoring team sees one thing, the security team sees another.
Exactly. Datadog's platform aims to break down those silos. It provides that single pane of glass, a unified view across everything. For the customer, that means faster troubleshooting, better collaboration, more efficiency. You find problems quicker when all the data is connected. And for Datadog, it makes the platform incredibly sticky. The more products you use, the harder it is and the less sense it makes to switch to something else. It becomes the operational backbone.
Creates a strong moat, essentially.
Mhm.
Now, one area showing particularly rapid growth is security. They had a big milestone there, didn't they?
They did. Their security suite, and it's a broad suite, covering code security, cloud security, data scanning, app protection, SIEM. The works it now generates over $100 million in AR. And it's growing fast in the mid-40s% year over year.
Wow, mid-40s growth on a $100 million base is significant. What does hitting that ARR number signal?
It's a huge validation point. It shows there's real market appetite for integrating security with observability. Traditionally, these were separate worlds, separate tools, separate teams often.
Right.
But in modern cloud environments, performance and security are deeply intertwined. You can't really separate them. Datadog saw this convergence coming and built security into the platform. This milestone proves that strategy is resonating. Customers want that unified view. And it also sets them up perfectly for the next wave, like using AI for security analysis, which we saw hints of with their Bits AI security analyst.
Okay, that leads us nicely into the innovation side. Their DAHH user conference back in June seemed packed with announcements. A major headline was the launch of these fully autonomous AI agents. Can you break those down for us? Bits AI, SRE agent, dev agent, security analyst. What do they actually do?
Right, this was a big theme at DSH. These aren't just dashboards showing data, they're designed to take action. The Bits AI SRE agent, for example, its job is to actually investigate alerts when they come in, figure out what's going on, and even coordinate the initial incident response. Think of it automating that first level of triage. Then the Bits AI Dev Agent is like an AI coding assistant, but focused on production. It aims to proactively find issues in the code running live and even suggest or implement fixes.
So potentially fixing bugs before humans even notice them.
That's the idea, yeah. Speeding up that whole development cycle and reducing production incidents. And the Bits AI Security Analyst focuses on their Cloud SIEM product, automatically triaging security signals, figuring out where ones are real threats versus noise. The overall vision here is embedding automation and intelligence right into the operational workflow, moving beyond just monitoring.
What's the impact likely to be on IT and security teams then? This sounds like it could change workflows quite a bit.
Oh, potentially profoundly. It's a shift towards more proactive, even autonomous system management. For years, the model has been tool alerts, human investigates, human fixes. These agents aim to automate significant chunks of that. Imagine freeing up engineers from the constant grind of alert fatigue and routine investigation. They could focus on higher level problems, architectural improvements, actual innovation. It might lead to a sort of human in the loop model where engineers supervise the AIs rather than doing all the grunt work themselves. It could really reshape IT ops. And they even mentioned things like an AI voice agent for incident response, further streamlining things.
A fundamental shift indeed. They also announced things aimed more at the developer experience, right? Helping teams ship better software faster. Like the Datadog internal developer portal. What does that offer? A software catalog, self-service actions?
Yeah, this tackles the complexity developers face. Modern systems are sprawling. The internal developer portal aims to give devs a central place to understand their systems. The software catalog provides real-time visibility, what services exist, who owns them, how they're performing, what APIs they expose. The self-service aspect lets developers provision infrastructure or manage code deployments themselves, following predefined templates, which speeds things up. And scorecards help enforce engineering best practices and standards automatically. It's about streamlining that whole inner loop for developers.
And there was something about an MCP server connecting AI agents to Datadog data.
Right, the Datadog MCP server. Think of it as a secure bridge. It allows AI agents like coding assistants from OpenAI or Anthropic or Datadog's own Bits agents to safely access the telemetry data within Datadog. So your AI coding assistant can actually see performance data or logs from Datadog to help it generate better code or diagnose issues right in the developer's editor, thanks to integrations like the OpenAI Codex CLI or the Cursor extension. It collapses that feedback loop between writing code and seeing how it performs.
So bringing observability data directly into the developer's workflow, that makes a lot of sense for speeding things up. Okay, what about core observability itself? Any major advancements there in understanding system data?
Yeah, quite a few interesting things. They introduced the APM Latency Investigator. Instead of engineers manually digging through traces to find the source of slowdowns, this tool uses AI to automatically explore different hypotheses, isolate root causes, and show the impact. It automates a really tedious part of troubleshooting.
Okay, so less manual data sifting.
Exactly. And then there are proactive app recommendations. This analyzes APM data to spot potential issues before they actually cause major problems and even suggests fixes. It's moving from reactive to proactive. On the logging side, they announced the Flex Frozen tier. This lets customers keep logs for up to 7 years in fully managed storage, but crucially, they can still search those logs directly.
So no need to rehydrate old logs just to search them. That's usually a pain.
Right. It's a big deal for compliance, auditing, or just long-term historical analysis. You keep the data affordably, but it stays accessible. And Archive Search complements this by letting you query logs stored in your own cloud storage, like S3, directly from Datadog too. Plus, they added more advanced data analysis features within their Notebooks product for deeper exploration.
So better root cause analysis, proactive recommendations, and much easier long-term log access and analysis. Sounds like a solid set of enhancements. Now, we touched on security earlier, but specifically regarding AI, it introduces new risks. How are they addressing the security of AI systems themselves?
This is critical because traditional security tools weren't really built for AI's unique characteristics. Datadog is extending its security products to cover these new attack vectors. They talked about 3 layers: data, model, and application. At the data layer, for instance, their sensitive data scanner is being adapted to prevent leakage of sensitive info within LLM prompts or responses or in the training data itself.
Protecting proprietary data being fed into models.
Exactly. At the model layer, they're looking at things like supply chain attacks, someone injecting malicious code into an open source model you download, or model hijacking, where an attacker tries to subtly manipulate the model's behavior. And at the application layer, they're helping defend against things like prompt injection attacks, tricking the LLM into doing something it shouldn't, or data poisoning during runtime. These are novel threats that need specialized defenses, which Datadog is aiming to provide.
It really highlights how intertwined AI development and security are becoming. Okay, broadening out again, what about observing the AI systems themselves? GPU monitoring, agent consoles.
Right, end-to-end AI observability. This is about understanding the performance and behavior of the AI systems you're building or using. So, GPU monitoring gives you visibility into your GPU fleet, whether it's cloud, on-prem, wherever. GPUs are expensive and crucial for AI, so you need to track their utilization and health. The AI Agents console lets you monitor how the AI agents your teams are using, whether Datadogs or others are behaving and interacting. LLM observability experiments help you test how changes to prompts, models, or underlying AI providers actually affect your application's outcomes. It's like A/B testing for AI components.
And understanding the decision path of these agents.
Yeah, they added a new visualization for agentic flows within LLM observability. It helps you trace how an AI agent arrived at a decision or took a sequence of actions, which is vital for debugging these often non-deterministic systems. And finally, they mentioned a complete approach to data observability across the whole life cycle ingestion, transformation, usage, which is boosted by their recent acquisition of Metaplan. As AI relies so heavily on data, ensuring data quality and lineage is fundamental.
So it's really about providing deep visibility into every facet of AI development and operation, from the hardware up to the data and the agent's behavior.
Precisely. As companies adopt AI more seriously, this level of observability becomes absolutely essential for building trust, ensuring reliability, and optimizing performance. The Metaplan acquisition significantly strengthens their hand in the data observability piece, which is becoming increasingly critical.
And as you noted, the industry seems to agree. Being named a Gartner Magic Quadrant leader for observability platforms for the 5th straight year, that's quite an achievement.
It really is. 5 years running in a fast-moving space like this, it strongly validates their core strategy. It says that their unified platform approach, bringing monitoring, security, developer tools, and now AI observability together, is not just a good idea on paper, it's delivering real value that the market recognizes. It cements their position as a leader, setting the direction for the industry.
Okay, let's shift from the platform and products to how this translates into actual business wins. Can you share some examples of customer expansions or new deals from the quarter?
Sure. These stories really bring the value proposition to life. Take a large global bank, for example. Datadog landed a big expansion there, multi-year, 7-figure annualized deal valued at over $60 million total. Their main driver was cloud migration, specifically so they could leverage AI for things like risk management using their massive data sets. Datadog became their strategic observability platform for that migration. And get this, they expanded to use 21 different Datadog products with thousands of users on the platform.
21 products.
Yeah.
What was the key thing that unlocked that level of commitment for the bank?
I think the aha moment was realizing that their AI ambitions were completely dependent on having a rock-solid, unified view of their cloud environment. Old tools couldn't cut it. Datadog gave them the confidence to accelerate that cloud shift, knowing they wouldn't lose visibility. Adopting so many products just shows how deeply Datadog became embedded as a strategic partner, not just a vendor.
Okay, how about another example? Maybe in a different industry.
Right, look at a leading U.S. insurance company. They had an expansion that grew from 7 figures into an 8-figure annualized contract. Their goal was classic consolidation, get rid of dozens of different tools, and expand their own cloud products. The results were tangible. They estimated saving over $9 million a year just in incident response costs because they had fewer, less severe incidents. And they improved something like 100,000 customer transactions that would have otherwise been impacted. They ended up adopting 19 products.
Wow, $9 million in savings is a concrete ROI. What drove that consolidation push?
It was the sheer pain and cost of managing all those separate tools: alert fatigue, slow response times, wasted engineering effort. It was inefficient and expensive. Datadog offered that unified platform, simplifying their stack and dramatically improving their incident response. That $9 million saving makes the value proposition crystal clear. It directly impacts the bottom line and customer experience.
Makes sense. Any other interesting cases?
There was an American media conglomerate with a huge challenge. Around 100 different observability tools scattered across 300 business units. Talk about fragmentation. They did a nearly 7-figure expansion, moving towards 21 Datadog products, including the entire security suite, and even replacing their old paging system with Datadog's on-call product.
100 tools. How did they even function? What was the turning point there?
I think the turning point was realizing that the tool sprawl wasn't just inefficient, it was actively hindering their ability to operate effectively and innovate. The cost wasn't just dollars, it was lost productivity. Consolidating on Datadog, especially including security and on-call, was about regaining control, streamlining ops, and letting engineers focus on creating value instead of juggling tools. It becomes the central nervous system.
That's a massive consolidation effort. What about outside the U.S.?
Yeah, a good example is a leading Brazilian e-commerce company. They signed a 7-figure deal. Their issue was their previous vendor just couldn't keep up as they modernized their infrastructure, moving to newer cloud tech. Switching to Datadog gave them immediate, full visibility into that modern stack, resulting in better stability and faster incident resolution. They started with 7 products, including the Flex Logs for long-term storage.
So Datadog's ability to handle modern cloud stacks was the key differentiator there.
Absolutely. The old tool was a bottleneck. Datadog enabled them to confidently move forward with their modernization plans because it could actually observe the new technologies they were adopting. It highlights Datadog's agility.
Any stories where the value was almost instantaneous?
Yes. A delivery app, part of a major U.S. retailer, 7-figure deal. On the very first day of their Datadog trial, using the real user monitoring and error tracking products, they found an issue that had apparently been impacting users for months but had gone completely undetected by their old tools. That's a powerful aha moment. They adopted 7 products initially and consolidated half a dozen old tools, plus achieved PCI compliance.
Finding something critical on day one that definitely sells the product.
Yeah.
It also shows how much can be missed with inadequate tooling.
Exactly. It highlights the blind spots that often exist. Datadog provided that immediate, actionable insight that led to real business value right away.
Okay, one more. You mentioned a customer returning to Datadog.
Right, a U.S. mortgage company. Nearly 7-figure deal. They had previously left Datadog and tried to replace it with about a dozen different open source tools. The result: predictable chaos, fragmented visibility, engineers drowning in alerts, poor customer experience. So they came back. They're planning to adopt 6 products upon their return, including replacing their paging system again with Datadog on call.
What's the lesson there? The allure of open source versus the reality.
I think the lesson or the aha moment for them was the painful realization that the perceived cost savings of DIY open source were completely overshadowed by the operational complexity, inefficiency, and negative impact on their business. Their return is a strong testament to the value of an integrated managed platform, especially for complex, mission-critical operations. The total cost of ownership for the DIY approach was just too high in terms of pain and risk.
Those examples really paint a picture of the platform's impact across different industries and challenges. Let's pull back to the strategic level again, particularly AI. Datadog sees it as a massive long-term tailwind, right? Building on cloud migration.
Absolutely. They see AI driving more cloud consumption, more complex applications, and therefore more need for observability and security. And they have this AI native cohort, hundreds of customers deeply involved in AI, including most of the top AI companies themselves. Over a dozen of these spend over $1 million a year with Datadog. Over 80 teams spend more than $100K. They view this group's rapid growth as a preview of what's coming as AI goes mainstream across all industries.
So the AI leaders are already heavy users, showing the path for others.
Exactly. And already, over 4,500 Datadog customers are using at least one of their AI-specific integrations, showing broad interest is already building. They also acknowledge that AI creates new observability challenges, understanding GPUs, LLMs, agent behavior, data pipelines, which their newer products are designed to solve. And crucially, they're not just observing AI, they're using it heavily themselves to improve their own platform, even doing fundamental research like that Toto time series model.
What are the strategic implications of being both an observer and a user innovator in AI?
It creates this powerful feedback loop, a virtuous cycle. Using AI internally helps them build better AI observability products because they understand the pain points firsthand. And having that massive, clean data set from all their customers gives them a unique advantage for training advanced AI models like Toto. It lets them innovate at a foundational level. So when they say they're just getting started with the AI opportunity, it reflects this deep belief that AI will fundamentally change everything, driving enormous long-term demand for sophisticated observability and security.
Okay, let's pivot back to the financials, but with some more nuance based on the Q&A insights. We know overall usage growth beat expectations, driven strongly by that AI native group, but with the rest of the business also growing consistently. That AI cohort is now about 11% of revenue, up from 8% last quarter and just 4% year ago. And it contributed about 10 percentage points of the year-over-year growth in Q2. That's substantial.
It's a huge chunk of the growth, yeah, which also explains their caution.
Right. They mentioned potential volatility from this group due to concentration and potential contract renegotiations down the line. It's a forward-looking caution, not something they're seeing yet. Meanwhile, usage across SMB, mid-market, and enterprise was pretty stable, maybe even a slight uptick in SMB and mid-market.
It's that balance again.
Yeah.
They're acknowledging the immense growth from AI natives, but being conservative and forecasting because, while these are often newer, rapidly evolving companies, their consumption patterns could change. It's smart management, learning from past cycles. But the fact that the underlying growth continues and the broader market, SMB mid-market, is also healthy provides a solid foundation.
Makes sense. Let's talk efficiency again. That 80.9% gross margin is strong, and they credited their own internal cloud cost-saving efforts, using their own cloud cost management and profiling tools to cut their bills. That's dogfooding at its best, right?
It absolutely is. It's incredibly validating. When you can show customers, hey, we use our own tools to save significant money and improve performance on our own massive cloud infrastructure, that's a powerful sales pitch. It proves the tools work in a complex, real-world environment, and it directly benefits their bottom line, allowing for more R&D investment. They expect margins to improve further because of this.
And operating margin was 20%, would have been 22% without the DHH conference costs and some FX impact. Still very healthy. What about investments? Operating expenses were up 30%, reflecting hiring plans and specific R&D increases for AI training and inference.
Yeah, they're definitely investing, especially in R&D and sales capacity. While some tech companies are cutting back, Datadog sees a clear ROI from adding people now, given the size of the market opportunity. The R&D spend, even with the shift towards AI compute costs, is fueling tangible innovations like the AI agents and models we discussed. And the increased sales capacity they added starting late last year is now visibly boosting new logo wins and pipeline. It's strategic investment paying off.
Which all leads to their guidance. For Q3, revenue $847 to $851 million, that's 23% growth year over year. Op income implying a 21% margin. And for the full year, revenue $3.312 to $3.322 billion, 24% growth, also with a 21% operating margin implied.
Yeah, the guidance reflects that balance we talked about, strong growth projected, healthy margins, but perhaps a touch conservative compared to the Q2 beat, likely factoring in that potential AI native volatility. It signals confidence, but also prudence.
Okay, let's dig into some specific topics that came up in the analyst Q&A. This is often where you get deeper strategic insights.
Definitely. It gets beyond the prepared script and into the tougher questions.
First, that broader AI opportunity. How does it move beyond the AI natives to traditional companies? Datadog talked about multiple layers.
Right. Layer one is the infrastructure companies running AI models, inference stacks in the cloud. That's happening now and will grow. But layer two is the really interesting part. observing the new problems AI creates, specifically understanding applications where the code itself might be AI generated, making them non-deterministic.
Mhm.
How do you monitor code that doesn't behave the same way every time? That requires a fundamentally new kind of observability, focused on how the code is working in production, its decision paths. They believe the whole market is heading this way.
So observability needs to evolve to understand probabilistic AI systems, not just deterministic code. That's a big shift.
It's a huge shift. It moves observability from just tracking metrics and logs to understanding intent, behavior, and outcomes in a much more complex way. This creates a massive new need across all industries adopting AI.
What about the security business again? Beyond the $100 ARR, what are the next growth levers?
Their focus now is shifting from just getting broad adoption, lots of customers using some security features, to getting wall-to-wall adoption in large enterprises, meaning becoming the standardized primary security platform across the entire organization. That requires more than just good products. It needs refined go-to-market strategies, maybe some customization, really selling top-down to CEOs. They also kept the door open for more M&A in security, suggesting they're actively looking to acquire capabilities to accelerate growth.
So deepening the penetration within existing large customers is key for security's next phase. Let's revisit customer segment dynamics. Enterprise usage growth was stable, while SMB mid-market improved slightly. They push back on comparing this directly to the old cloud migration wave.
Yeah, they made a good point. AI natives often have explosive, sometimes unpredictable infrastructure growth. Enterprises, even when adopting AI, tend to have more planned, controlled migrations, often limited by their own internal resources and change management processes. So while enterprise usage growth might look moderate quarter to quarter, the strong bookings and product attachment trends suggest big commitments are being made for future deployments as they roll out AI more broadly. The pipeline is strong, even if consumption ramps more gradually.
That's a key distinction, bookings showing future intent versus immediate usage. And that brings us back to managing the AI native volatility. How are they handling that ongoing concern?
They acknowledge the risk exists, factored into guidance, but emphasize they haven't actually seen major optimization kick in, yet the growth continues strongly, and they're winning share. They stress the timing is unpredictable. When or if a huge customer decides to optimize is based on their own business needs and cycles. But they also pointed to their high overall retention and the fact customers who leave sometimes come back, suggesting the platform's value proposition is strong enough to weather potential short-term fluctuations.
The stickiness provides a buffer. What about adoption of their own AI features, like the Bits agents?
Feedback so far is apparently pretty positive. They seem particularly encouraged by how well the AI SRE agent is working in early trials. The main focus now is just scaling these, making them widely available because customers are apparently eager to try and buy them. And again, they reiterated how using their own cost and performance tools internally led to substantial improvements, which they're now productizing for everyone. That internal validation cycle is key.
And the Salesforce expansion. They invested heavily, especially internationally. Is that paying off?
Seems so. They said the investments from late 2024 are showing good signs. Now, more new logos, bigger pipeline. They're deliberately pushing harder into international markets like Brazil, India, APJ, the Middle East, which requires more upfront investment but unlocks huge long-term potential. And they're balancing incentives to drive both new customer acquisition and expansion within existing accounts. Despite broader tech slowdowns, they clearly see strong ROI in adding sales and product headcount right now.
Finally, the competition question. Grafana, Chronosphere, others. Has the landscape changed?
Their perspective is, competition has always been fierce, and the core dynamics haven't fundamentally shifted much. Their strategy remains the same. Win by being the most integrated, end-to-end platform that solves the most problems for the customer, rather than being just a single-point tool. They believe their economic model allows them to out-innovate competitors by investing more in R&D, building more products faster, and covering more adjacent areas, ultimately offering more value through that unified platform.
So the integrated platform and pace of innovation remain their key defenses against specialized competitors.
That's the core thesis, yes. Breadth, depth, and speed of innovation on a unified platform.
Well, this has been a fascinating look under the hood at Datadog. We've seen strong financial results, a really accelerating pace of innovation driven heavily by AI, both in their products and as a market tailwind, and a clear strategy focused on that integrated platform. It definitely paints a picture of a company trying to position itself right at the center of the next wave of cloud and AI adoption. Hopefully this discussion gave you some valuable context on these major tech shifts. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.